Let me get right to the program now. I want to introduce our speaker. He is an accomplished author, facilitator, family wealth strategist, and for many years, he worked with enterprising business families and their advisors to help them develop goals-based intergenerational wealth plans. So in addition to being a finance professor at Fanshawe College, he's also a member of the Canadian Association of Farm Advisors. He's the host of a podcast called Inception Family Wealth Hour. And get this, the author of a book called The Naked Opus, Growing Your Family Wealth for the Long Term. So it's my pleasure to welcome to this FCC event, Mr. Chris Delaney. Hey, Chris, how are you?
Kevin, I'm doing great. Thank you so much for the kind introduction.
We're glad to have you here. And I mean, I don't want to trip you up too much, but that title, The Naked Opus, I bet you in a Google search that gets some interesting results, I suppose. Maybe that's why you picked that name, did you?
Well, that was a sort of a humorous byproduct what came out of that. But I get a lot of, you get those anonymous texts and emails, nice. And it says, "Hey, naked." That's usually the first thing. I know I don't know the person when I get that.
Well, people want to hear what you have to say. So, Chris, the virtual floor is yours.
Kevin, thank you very much. It's a tremendous pleasure to be here today. As Kevin mentioned, this presentation is about the 5 biggest estate planning mistakes that everybody makes and how to avoid them. There are actually 10. It's part of an upcoming book that I'm publishing in having published in the early part of 2021. But I thought I would highlight 5 of the most important ones here today, and then provide you with a couple of practical solutions for some of those in a goodie, if you will, that you can connect to and download for free after the show. So one of the places I like to start is to ask you why you are here today. And I'm not expecting you to answer that because of the structure and time constraints that we have with this particular production today. But I always like to make sure that I ask and have people thinking about what it is that's drawing them to an estate planning event. And this picture, I think, is a nice picture because I think it is a good metaphor for some of the emotions that you might be feeling with your estate planning. Very tall trees in front of you as you are on your journey. It's hard to see up sometimes to catch the horizon or even where you've been. And then you've got these turns and curves ahead of you that you can't see around and that are a struggle for you moving forward. No one likes to drive blind into things. And so as we're going through this event today, as I'm talking, think about some of the reasons that you're here today. What's driving your passion for estate planning? I'll tell you that I think you're here today because you have a fear about being fair. You have uncertainty about whether you have the right tactics in place to achieve your estate planning goals. Almost always on these kinds of events, people have fear about divorce and family breakdown that will destroy everything that they've worked for to build, including the lifestyle of farming, which is so incredibly important. You don't know how to get started or where to get started, who the right professional is to begin this journey of planning with. You fear that continuity of the farm will be lost on your death and your family struggles to communicate. That's why you think you're here. You are really here because of those key words that were buried inside of those statements. You have fear, you have uncertainty, you don't know, and you have struggles, for example, with communication. It's those emotional things that are actually driving you to the action of being here today. And it's really important to remember that as we proceed through these mistakes that people make, because what I'm going to try and interweave are the marriage of tactical solutions that people like to use with what should be done first. So what we have here usually is a competition between the rational side of our minds that want to achieve tactical outcomes and the irrational side of our mind that is emotional. And when I say irrational, I'm actually not using that in a pejorative term. As humans, we are irrational. It's who we are. We're emotional. We always respond first with emotion. And as I've highlighted already, most of you are here today because of fear, uncertainty, a sense of struggle that you're having. And it's very common. And our biggest decisions are propelled by those fears. And it's that interplay between thinking up here, where we like to think we think, and thinking down here in our heart and in our gut, where we do most of our decision making. So this presentation today is about decision making and making better pre-planning decisions. I like that Kevin mentioned that. Better pre-planning decisions as we go through this process. So how is estate planning decision making? These are some of the many tactical questions that you're going to be asking yourself as you prepare your estate planning. Who or what will be my estate trustee? Who will be the guardians of my minor children? Who will advise me about these decisions? Where do I begin with that? How can I be fair? What if my family has conflict? Do I need to be equal? What if there's cancer, divorce, planning mistakes, financial failure, substance abuse, general disinterest, or inability, just not able to do the job? What if I die before I'm ready? What if I die before my family is ready? What if I die before the farm itself is ready to be transitioned? And, what if I don't die and I'm just left incompetent? Which, by the way, you have much more significant likelihood of having occur than dying. Well, ultimately we all die, but at an inopportune moment. Incompetence is actually the one you really need to worry about the most. So all of these are decisions, and all of these decisions, if you look at them, tend to deal with the how and the what and the who will assist me. And I'm going to try and take you a little bit deeper today. I believe that estate planning decision-making, and generally speaking, farm succession planning decision-making, because I interrelate the two. I don't think you can do the two in distinct silos, if you will, because they are interconnected. If you are doing your estate planning, you're probably doing some of your farm succession at the same time. And it's good to think of it that way. And the problem that presents, and you've probably all seen this particular, or this kind of an idea before, where we show interrelated circles that overlap one another. If you've ever had someone present on the 3-circle model of family enterprise planning, you'll be familiar with this basic idea, but this applies in a much more multidimensional way to other aspects of decision making. So for example, up in the top left corner there, what if there is conflict or tension in my family? That's an estate planning issue that we have to deal with. If you make a decision in that particular circle, in that particular ecosystem of system of decision making, it causes waves that ripple right across to the bottom right-hand corner of who gets what assets. Similarly, when you make your decision about who gets what assets, it rolls over into either creating or exacerbating or continuing conflict and tension. A simple decision, like who or what will be my estate trustee, causes fair versus equal issues, because that decision is laden with meaning, laden with history, and laden with a sense of continuity to a past and into a future that has to be reconciled when you do your planning. So none of those earlier decisions that I highlighted are actually standalone decisions. They ripple into all the other areas of our planning. Why am I here today? Because I think I can help you see and envision your estate planning in a way that will help you create a better plan with more effective decision making that helps you achieve the goals that you want to achieve at the end of the day. So here are the top 5 mistakes that I highlight in my book. And they are in a particular order. 5, failing to consider the possibility of a black swan event. And I'll deal with each of these in turn as I move through the presentation. 4, thinking about estate planning as an event rather than a process. 3, planning for the assets rather than preparing the beneficiaries and the heirs to receive those assets, to be good stewards and good beneficiaries. Assuming your family will understand your intentions after you die. I hope there's a lot of people leaning back going, oh boy, right? That's I mean, in many cases, that's the number one mistake people make. But I think I've identified another one that I think is more important, one that I like to think is the most important one. And that is not dealing with an irrational interface that I'll deal with later in the presentation. So let's get right into it. Failing to consider a black swan event. What is a black swan event? Well, economist and author Nassim Taleb has described a black swan event as an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Black swan events are characterized by their extreme rarity. So it's not something that comes along very often, but they have a severe impact. They cause a lot of trouble in your estate planning. And I want to keep it into that paradigm if I can. And usually in the hind view mirror, if you will, they're often thought of as, oh, not possible to ignore. We could have seen them coming. So what is the black swan context in the context of your estate planning? And that's what we're going to explore here. Remember, this is from your perspective. What's catastrophic for me in my planning may not be catastrophic for you. And what's catastrophic for your neighbor in their planning is not likely to be catastrophic for you. We all have unique catastrophic outcomes. Let's take a look at this list here. A child gets divorced. A child dies before their parent. A child becomes ill. A parent enters a long-term care facility. A pandemic shuts down your business for 10 weeks. A child or grandchild is disabled, or a parent becomes disabled, or even incompetent. Are these extremely rare events? Do they have a severe impact? I'm going to suggest to you that these are not black swan events at all. When we do estate planning, these are the kinds of events we have top of mind. This is actually what's propelling the emotion in our planning, but it can be much more severe. So here's an example, and it's an example of something I'd like you to think about. So Emily is 31 years old. She's single, she's outspoken, she's very bright, she majored in philosophy, and as a student, she was deeply concerned with issues of discrimination, social justice matters, and also participated in anti-nuclear demonstrations. I want to ask you, which of these two outcomes that I've suggested here is more probable? A, that Emily is a bank teller, or B, that Emily is a bank teller and active in the feminist movement. Now, over the years since the book came out, I've done this presentation at innumerable events, and almost every time, I think I've had the vast majority, I can't even think of an event where I had anything approaching a significant number of people who chose the correct answer here. And the correct answer actually is that A, Emily is a bank teller. That's because the second choice that you have there, that Emily is a bank teller and anything else, is actually two events being conjoined. And when we conjoin events, we are actually multiplying the likelihoods of those events occurring times each other. So if we applied a 50% chance, very high, arbitrary 50% chance that Emily's a bank teller, and then a 50% chance that she would be active in the feminist movement, that's not a 100% chance that B would be the outcome. It's actually more like 50% times 50%, which is a quarter. So B is always less likely. And I'm going to come up a little later in the presentation on why that is a very troubling mental thing that we have, that we can't deal with those numbers very well. That's called a conjunctive fallacy, and we're not very good at decision making. We like to think we make very rational decisions, but many of you would have selected B there, and B is not the correct answer. Now let's go back to what constitutes a black swan event, because that little exercise is a big part of the thinking on this. A diagnosis of cancer in and of itself is not a black swan event. A vast majority of Canadians will suffer some form of cancer in the lifetime. But what if we add to that and therefore multiply? Before insurance is placed, would that cause you a severe consequence? What if a child died after the wealth had been transferred to them during your lifetime? A gift. How hard is that to get back? Would that have severe consequences for your planning? What if the business failed, leaving no assets for equalization? So we're conjoining events here. What if that happened? would that cause a severe consequence for you? At the top of this slide, I have that 50% of adult Canadians do not have a valid will. This was a 2016 Ipsos Reid poll, and in that poll, 50% of adult Canadians confirmed this on a self-reporting basis. Another 16% identified that they had a will, but it was so badly out of date, it was effectively useless. So 66% of all adult Canadians have a very bad estate plan, either zero or out of date. That has a likelihood to it. You know, if someone dies, there's a 50% chance it's going to be one of them, higher than that, actually. And then we apply one of these, now we're into black swan territory. And that has severe consequences for people. So failing to identify black swan events is one of the mistakes that we make. Thinking about estate planning as an event rather than a process is another mistake that we make all the time. Many of you are probably familiar with the concept, the idea of shirt sleeves to shirt sleeves in 3 generations. A lot of really good thinkers out there introduced that idea. And Jay Hughes, if you ever get a chance, I've identified him really as the gentleman who's collected this list. But he's identified 7 contributing causes to the destruction of family wealth between 3 generations. So you probably know that only about 5 to 6% of family wealth actually make, farms are a little higher than that because there is actually a fair bit of thoughtful heirloom thinking that goes with that. But in general, everywhere else, it's only about 5% makes it successfully through the 3rd generation. And in this particular list, I think what I want to highlight, because I'm going to deal with some decision-making biases and some problems that we make, is that 1, wealth preservation tends to focus exclusively on financial wealth and some of the problems that causes with our decision-making. The 3rd one there, that families fail to think long-term with their wealth. They think very short-term, usually tax-driven planning. And 4, they fail to manage their internal and external threats and opportunities in relation to their wealth. They don't take things like black swan events seriously. Now, I addressed this in a book I published in 2018. What I wanted to just introduce to you here was that within that book, I have what's called the abundant estate. It's actually, it's not meant to be a prescriptive process, but it's a process that if you went through it, I think would give you a strategic advantage in assessing some of the shortcomings in your planning and some of the blind spots that you might have. I always start off by having a family meeting to get people used to distributed decision-making and sharing the responsibility for stewardship and asset creation. Then, as you get used to those meetings, use a meeting cycle to discover and articulate your shared family values. The starting point is always with values. 3, use a meeting cycle to create a family mission statement based on your shared family values. Another tool that many of you will be very familiar with. Then I built what I call the SMART strategic process, which means that success in the achievement of the mission is made possible by identifying personal and family goals. We bring meaning to that by setting clear objectives in our planning. Then we create recipes for action. And then finally, we do the tactics. And the reason I identify this is because oftentimes in that first slide that I put up, what do you think of when you're thinking of your planning and the decisions you have to make about choosing an executor? We often jump right to the tactic before we've considered any of the preceding steps that would be S, M, and R, including all of the meetings. Now, I acknowledge that misspelling SMART, some of you will get what that is, but misspelling SMART was actually on purpose. And that's because the missing A of this process is the adaptation skills that your family will create if they actually use this strategic process. Okay, they build this sort of floating adaptability skill. And it's interesting because a lot of people say, well, that's sort of Darwinist, but Darwin actually didn't say the strongest shall survive from generation to generation. What Darwin said was that those that were best able to adapt will actually move from generation to generation. Now, that may be through strength. It's possible that that's the case, but it's adaptability that we're looking to build. Finally, you want to make sure that you can assess the strengths of your advisory team and those that are around you. Now, the third problem The third mistake that people make is planning for the assets rather than preparing for the heirs. And this is very bad for intergenerational planning. As Hughes already noted, or as I've highlighted that Hughes notes, this particular mistake causes the destruction of wealth in 3 generations. It's one of the major contributors. We tend to plan for our assets. So this is kind of where there was a poll available for you to complete. And I don't know if anyone's had the opportunity to complete that poll, and that's okay if they didn't. I'm thinking probably that didn't happen, but had it happened, had we gone through with the poll, this is what I do at every event when I'm speaking live. Hands go up. The first thing out of everyone's mouth is taxes. That's what I think of when I die. I think of wills as part of estate planning. I think of powers of attorney as estate planning, life insurance, probate tax. Probate tax in Ontario is 1.5%. It's actually one of the last things you should probably think about. Lawyers and accountants, of course. I mean, because we have a monopoly on advising in that space. And finally, conflict. That worries a lot of people as well. Here are some of the very specific questions that you might ask as you go through that process. And what I'm asking you to consider here is, what process do you have when you are assessing these particular questions about your estate planning? So do I have my beneficiary selections made? I've asked that probably 1,000 times over my career. I'm better at it now. What's missing from that is, and why? Have I selected my estate trustee? A trust is a relationship. An estate is a form of a trust. It's a relationship between a trustee and a beneficiary. If you really think about it, the trustee is stepping into your shoes. You've died, but your assets continue on. The decision-making over that is going to be replicated by the estate trustee. This person has to have a relationship with your beneficiaries that is at least as healthy as the relationship that you had with them, if not better. And we have the opportunity to do that in our planning. Have insurance policies and financial documents been ordered? So there's a clerical part of this that we often go through. Have the tax minimization strategies been optimized? That's probably the #1 place people start. And how much will each beneficiary receive? Well, that's often of interest to the beneficiaries as well. These are all excellent questions. But if we'd done this poll, and when I asked you what you think of about estate planning, what would have been missing? 99 times out of 100, people forget to say, oh yeah, the beneficiaries. They never mention the beneficiaries, very rarely. And that's because we are trained from the day we begin acquiring assets to think of the tax implications and to think of them as what we need to plan for. And I'm going to suggest to you that what we should be planning for is the beneficiaries instead. We should be inviting their input on a lot of this, because that should be the planning point. An important part of that is framing the conversation. Now, after this event, I invite you to, I'm a big believer in the sort of intrinsic wisdom that comes with TED Talks. So there's a lot of really great stuff that really make you think. But check out that one by Paul Piff. Actually talking about money makes people mean. A few years ago at the University of Minnesota, a professor, Kathleen Vose, did an experiment. And in the experiment, what they did was they took those little pencils, you know, that you get from a golf course, and they created a control group, and then they created a group that they were going to mess with a little bit. And they did this over and over and over again and got the same kinds of results. What they did with the control group was they showed them no images. There were 10 of them in a room. They were shown no images, given no stimulus, no framing whatsoever. Nothing is mentioned to them. Then they come out and they bump into a confrere, if you will, a conspirator who's part of the experiment. In another room, they have a group of people who are being primed with visions of money, visuals of money. There's monopoly money on the table. There are pretend coins. There's tapes running showing money, 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 money. And then that group comes out and bumps into a fellow conspirator that's part of the experiment. And you know what they consistently observed? The people that were primed with money were about 25% less likely to help the person when they knocked them all the pencils out of their hands than the people that hadn't been primed with money. Talking about money makes you mean. And so I changed a lot of the consulting work that I did once this became apparent to me by actually meeting in places that had nothing to do with money, maybe at a hotel, in a conference room or something like that, to take away some of that framing stimuli. So framing the conversation is very important because talking about money can make us mean. Now, the number two problem, the number two mistake that people make is assuming that your family will understand your intentions after you die. And I hope everyone in the audience is going, oh yes, assuming is never good. It actually is a surrender of your responsibility. It's an abdication of your responsibility to advance your intent into your family and into your planning. And it even gets worse than that, because when you make assumptions that people understand what you wanted, you are actually casting onto them the responsibility to read your mind properly. And that never works very well. It creates entire waves of problems in the planning. So over the years, and I've been doing this for about 30 years now, I collected statements, I collected things that I read, and there is trouble ahead if you hear any of these anywhere uttered or written. Because, and insert the business child's name here, has been so instrumental in the farm business, that's trouble. Okay, because that's actually forcing over to the farm child, in this particular example, the responsibility, because you've died, for explaining just what it was that went on. Okay, so instrumental. And there's a matter of perspective. How instrumental was that person? You might have felt they were instrumental. Did they feel they were as instrumental? Did the other people observing over the years feel that the instrumentality was the same, the level was the same? For reasons my children already understand, I divide my estate as follows. That is, it's humorous only because it's so unhumorous. What will happen after that? When you have to say something like that, there's trouble ahead. That's the equivalent. I once did a meeting with a woman who happened to be 85 years old. I wasn't connecting with her. I asked her, where I'd missed, and she started off, bless her heart, by saying, "Oh dear." That's the equivalent of that. You're in trouble when that kind of a statement comes out. Insert the beneficiary's name here, will receive a greater lesser share of my estate because. Remember, this is your will. You've passed away. You are not there to explain it. And people might not agree with your because. And in fact, it's from your perspective. So it may actually not be correct. I mean, it's correct from your perspective, but it may have some of the decision-making biases and some of the cognitive heuristics and shortcuts that we use to make decisions baked into it. It is my desire that so-and-so will be consulted and his or her counsel respected in any decisions. I've read too many wills over the years where the advisor is trying to make the client is trying to make their advisor the advisor to their family. Doing it in your will is not a great idea. If you want to do something like that, start today with that. And you're always going to be bumping against the issue that the children in the next generation of potential owners are going to view that particular advisor as your advisor, your guy or gal, as the case may be. And ask any advisor a financial advisor who's listening in on this presentation day, the stats on retention of certain types of clients after the principal client has passed away are horrifying. When a husband passes away, husbands usually predecease their wives. When that happens, in about 80% of the cases for financial advisors, the female survivor leaves to go to another advisor shortly afterwards. This is something that you want to build into your planning today, if that's really important to you. Don't leave it in your will. I know that you will respect my sincere desire that, okay? That's just trouble ahead. As the eldest, insert literally anything in here. Sibling rivalry is real, and just hoping that it will go away and that everyone will understand because they're oldest, youngest, middle is not good planning. It requires purposeful intervention. Fair doesn't necessarily mean equal. You've all heard that. I've been in so many meetings, hundreds of meetings over the last 30 years, where that little bomb's been tossed out very innocuously, and everybody kind of laughs, and nobody really understands what it means. It tends to shut down the conversation because fair has a meaning, equal has a meaning, and equal tends to mean equal. Fair is a matter of perspective. I usually start from the standpoint that if it isn't equal, it isn't fair. And you should probably have some sort of a narrative built up before you die so that that is very clear what you meant by fair. It's also good to understand what other people mean by fair as well. And finally, throughout my lifetime, I've made my intentions clear. If that were true, you wouldn't have to do it in your will. Now, here are some factual red flags in any planning. So those are sort of verbal red flags. Here are some factual red flags. Cottages, farms, family businesses, second marriages. Anytime we see those kinds of issues, those are latent with problems from a planning perspective. Anytime I read a will where there's a total disregard for obvious issues in the family, where there are heirloom assets in addition to the cottage, farm, or family business, which are intrinsically imbued with both passion and a sense of history and a sense of connection. Anytime there's uneven beneficiaries in a will without a decent explanation, inter vivos, while you're alive, is trouble ahead. If anything's being left all to charity, which is fabulous, that sometimes is a red flag that something else is trying to be achieved. Another one is if there's no will at all, because the dispositive provisions of the various provincial succession law reform acts that deal with intestacies are not usually what you think they are. They are not going to achieve what you want to get out of it. And finally, changing key advisors into this prism of the family's decision making is actually maybe a collection of other perspectives and viewpoints. And the thing I want you to also remember is that the light can come from the right to the left on this as well. You can actually manage through good process to collect the rainbow of perspectives in your family and create a bright light for planning. So the light can be coming from multiple directions here to achieve the goal. You're all probably familiar. I'm not going to spend too much time on this, but one of the assumptions that we all make is that we're clearly understood. And most of the time we're not. And that's because there are at least four basic communication styles. So some people are unidirectional, I talk, you listen. Some people are very inspirational communicators. They avoid unpleasant subject matter and they're not detailed. They speak in abstractions. Others, one-to-one. That's when they get things done. And then there are the detailed and fact-based communicators. What's your communication style? What's the communication style of the person you're trying to share your estate planning ideas with? What's their style in relation to yours? How does your advisor fit in that? Understanding people's communication styles is absolutely critical to getting over that, I assume you knew what I meant when I was talking. Now, in this particular place here, these are some of the decision-making biases that I have integrated into the new book that's coming, but that we encounter all the time. So we've already seen the conjunction fallacy. One of the ones that pops up is the optimism bias. And when I have historically over the years worked with people, I would have, let's say a farm family in front of me and they've got 4 children and all 4 children are married. And then I will say to them, okay, the divorce rate in Canada on first marriage is just a little below 50%. Let's say it's 50%. When we're doing our planning, which of your 4 children, which 2 of your 4 children are going to end up divorced? And usually there's a fair bit of laughter and everyone says, oh, that doesn't happen in our family. And then they begin to realize the shoe drops and they realize, oh my gosh, that's probably a ridiculous comment because that means somewhere else there's a consultant meeting with a family with 4 married children and they're all going to get divorced. So we have to be realistic. It's good that we're optimistic, but we have to be realistic about the planning that we're going to do. So I'll deal with some of the content of this in another slide upcoming. The number one, and this is one that I've tried to develop, the number one problem that I've identified is that there's an inability to cross the rational irrational interface. So I'm going back to the beginning now, and I took that list of fears that people have and concerns that people have that bring them to events like this. I culled that out of a list specifically prepared for this event. And those are irrational. They're emotional in that sense, not in a pejorative sense, but they're human emotions. Then we have rational outcomes that we would like to think we have. So clarity, certainty, knowing things, being able to manage things. And finally, things are expected. What we encounter in our planning is expected. And the problem is there's a mountain in between some of these, in between these two hemispheres of decision making. And that mountain causes paralysis. We stop planning, we procrastinate, we freeze. Sometimes we flee the planning altogether, and sometimes we fight. That's another reaction. But going into estate planning, going into succession planning with a farm, fighting is not always the best mindset. So what I'm trying to introduce here is an idea that we don't have to treat that center space as radioactive. It is actually a safe place if we manage our way into it with some thoughtfulness. And here's the really cool part about all of this, that the extent to which we are irrational is actually predictable. We can actually predict when we're going to be irrational. So let's take a look at a couple of these. The first one, we use comparative thinking to make decisions. We all do this. It's irrational, but we do it all the time. If we understand that every analysis we're making is relative, say, to a worst case scenario, that's usually where we jump to, we can purposefully build processes that contemplate baby steps towards an intermediate scenario. The second one here, what have you been anchored to? So I talked about that anchoring in the previous conversation. Now that always brings me to a really interesting case that I had a few years ago. Of a family that there were three siblings. They were fabulous. They were, they all had exuberant ideas, great planning ideas that they brought. And I met them all at their individual farms, and then we went back to the home farm for the sort of summary meeting and to get things started. And what I noticed when we got back to that particular location was that they suddenly were no longer exuberant, and only one person was leading the conversations. And what was going on there was that the farm, the home farm, because it was owned by the parents and was now owned by the oldest brother, and it was the place where all the decisions were made. It was the power locus. It framed the conversation. It changed how people responded to our interaction. So once I realized that's what was going on, we started having our meetings I'm in London, Ontario, at a hotel here in London. We rented a nice room for that, and I got those siblings back again, which really helped. Again, here are some other ways to manage irrationality. I will share this with you afterwards in a document. I just want to keep moving forward here in the interest of time. What that actually allows us to do, if we understand that we can manage our own emotional irrationality, we can change that center zone, that crossover between irrational and rational decision making, from a nuclear zone into a mind the gap situation where we can actually get across it and do some really good planning. Now, I want to take an opportunity here. What I've done with this presentation is I've identified 5 estate planning mistakes that everybody makes. I've created a 17 or 18 page document that re-identifies those for you, and then actually gives you some solutions that you can go through in your own family, little exercises that you can pass through to help you combat those particular estate planning mistakes so that you don't make it. Not meant to be an exhaustive list, but I would encourage you, to go and download that if you want. You just have to go to familywealthpress.com, enter the coupon code FCC 2020 December. Okay, I think it's all in lowercase. And then I'm also offering my book, which is The Naked Opus, at 20% off, again, at the same site, and use the coupon code FCC Naked Opus. And I can make that available after the event as well. Now, here's one of the tactics that I introduced. And this, I think, is one of the best ones. It's powerful to deal with many of the 5 problems I've already identified. Conduct a pre-mortem. So here's a really simple fact pattern. Peter and Emily Smith have been married for 30 years. They farm. They have 3 children, Bart, Lisa, and Maggie. All 3 children are married, and all 3 farm. Each child has 2 young children. So this is the simplest of situations. They did their wills 10 years ago that leave everything to one another. And if one of them passes away, it goes to the spouse. If the spouse passes away, it goes to the 3 children equally. That's a mere will situation. A lot of you will have that plan. They also did their powers of attorney, changing who the appointments were. The son was in charge of the property. The daughters were in charge of the personal care. So a very straightforward situation. What I want you to think about, and do this in your own planning, when you're doing doing a pre-mortem, think about the key assumptions in relation to some of the things we've talked about here today that underpin what they expect will happen with that planning. The 3 marriages will stay together, as Peter and Emily did. The children will need the estate assets equally. The children will get along forever. Peter and Emily will stay healthy. The spouses will remain healthy. The Smiths will agree to change things if things go awry. And finally, the children will plan in accordance with expectations they have accurately ascertained from their perspective. We know that's a problem. I could go on. Those are some of the key assumptions that this Peter and Emily have built into their plan. So when we do a pre-mortem, we challenge that and we say, which of our key assumptions, if it went completely off the rails, would cause my entire estate plan to blow up? And here's a fact bomb. This is from a real interaction that I had. It's so crazy and horrible that you probably think it's fiction. Maggie's husband was having an affair with Lisa. Bart was diagnosed with cancer and was uninsurable. He's thankfully still alive. So in this fact pattern, the Black Swan event was that the youngest daughter was having an affair with the middle child's spouse. And their decision making, I know, I can see some of the hosts and they're going, what? And it was a real case. And that was a fact bomb that went off. Their key assumption was that their family was normal and that everything, we had successful kids. We had the ability to just leave everything out to them. They get along forever. We don't have to worry about it. If they inherit this wealth, everything will work out just fine. And then this happened. Now, I won't share with you what the solution was here, except to say that it was ugly and continued to be ugly. But this could have come out a lot sooner. And there could have been an opportunity to manage this in a much better way than having it happen at the particular table that it happened at. What are some of the biases we've talked about that were in Peter and Emily's planning there? Well, there's the optimism bias. There's the conjunction fallacy that I talked about earlier, where people just aren't good at putting together events to see the risk of something bad happening. There's another one. There's another bias that we have that's called Wizziati. What you see is all there is. We have a real tendency, once we get a solution that we like, to ask no more questions and to do no more analysis. We like what we see. It kind of fits the paradigm of what we're used to and what's available, and we stop there. And the other one is the Lake Wobegon effect, and I've highlighted that one earlier. There was a radio show in the 1930s, and it started off by saying, in the town of Lake Wobegon, all the children are above average. And of course, that's not possible. So these are some decision-making biases just in the assumptions that Peter and Emily were making. So what are the top 5 mistakes again? Failing to consider the possibility of a black swan event. Thinking about estate planning as an event, a discrete event, rather than as a process you do for your entire life. Planning for the assets rather than preparing for the beneficiaries and heirs to be good stewards, good beneficiaries, and good wealth creators. Assuming your family will understand your intentions after you die. And finally, not dealing with that rational interrational interface as something that we can predictably manage if we build process. And process is always your friend in these situations. So that concludes the presentation. I think I'm actually on time. I'm getting thumbs up on that, which is good. I just want to remind everybody that if to download that worksheet that I prepared, it's got solutions. I think it's about 18 pages long. It's free. Use the code. You can download. I re-identify all 5 of the top estate planning mistakes. Then I build in some specific situations and then give you an example of a process or a tactics, something you can do as a family that will help you deal better with that particular aspect of the decision making. So that concludes my presentation. Kevin identified that the podcast is available at Inception Family Wealth. That's out on Apple and Spotify and Google Podcasts. And there's the other contact information if you want to get a hold of me. I think people are coming back on. Are we dealing with questions here? Or
yeah, we're going to have some questions here. And Chris, thanks very much for that. Just a reminder to the folks You can see the book and his Chris's contact information. We're going to, if you missed the code, the coupon code, we're going to actually include that in the email that will be
very
sent
good.
to you later. So just in case you missed it, no worries, you won't miss out on that. So yeah, Chris, really appreciate your insight on that. Boy, I'm telling you, I'm a guy who grew up on a farm. So farm with my dad, farm with my father-in-law. So I've been through this whole estate planning thing twice now. And when you start talking, I can feel my blood pressure going up and up and up. And I just gotta be calm.
Well,
I gotta be calm. And I'm
I
sure that
create these horrible scenarios and I feel really bad, but there's worse ones that I didn't want to put up because they seem like
yeah.
fiction.
Well, but when you say you create these horrible scenarios, and yet, tell me if I'm misquoting you, because I don't know if I saw this in your book or someplace else, but I thought it was you that said that the way we plan guarantees that wealth will be destroyed in about 3 years, so three
Yeah,
generations. I mean, is
that's
that
right.
well? And so when you say you're creating bad situations, well, that's almost a guarantee horrible situation. So it's really that tough.
Well, it is that tough, and
Yeah.
I think there's a reason, Kevin, why 50% of adult Canadians have no will, and another 15% have wills that are badly out of date. I think they fear approaching this because there are so many moving parts that they don't understand and which they feel are combustible
Yeah.
elsewhere. And the problem with doing nothing is that that's a choice too, and it's also a choice. It's a choice of educating the next generation on how to deal with similar problems that they're undoubtedly going to face, and these problems just get exponentially worse from generation to generation. It doesn't get better. And
Yeah.
I hate, when I say I create these terrible scenarios, I've been doing this for about 30 years now. Most of them are based in, well, that one I just told you where Maggie has an affair with
Yeah.
Lisa's, I obviously changed the names to protect the innocent. That was
Yeah.
real. And
Wow.
I never thought I would ever see that. I've seen
Yeah.
estate freezes done where the wealth has been transferred in one case in this one particular case to a child. And at the time of the freeze, it was $2 or $3 million. It was about 15 or 16 million 6 years later because land prices had gone up so much and
Yeah.
there had been so much growth in the wealth of the business. And the mismatch in the estate was out of control. And then there were illness, like people had diabetes, they were just
Oh,
aging, and there
wow.
was no way to, like, typical tactics to deal with that are
Yeah.
things like life insurance and things like, well, that's
Sure.
a very good tactic. But as we procrastinate and as we allow things, as we flee and run away from those kinds of difficult decisions, we
Yeah.
lose planning opportunities, fall off the table. So I have seen some the truth is often a lot worse than the than the fiction.
Yeah.
Now, I also want to say I've seen some
Wow.
amazing planning as
Yep.
well. And what
Yep.
I'm suggesting is that we can avoid that shirt sleeves to shirt sleeves if we adopt a mentality that we have a responsibility to do this planning. We shouldn't shirk it, and that we need to invest in the beneficiaries, we need to invest in the purpose, and we need to invest in the why. I saw one of the questions that popped up on my screen, I just deal with it super fast, was
Sure.
another tactic. A really great one, other than conducting a pre-mortem, is
Hmm.
to simply ask yourself why 5 times, and actually put a fairly detailed pretend interaction in that document you can download. But let's say you go, I need to avoid probate tax. Ask yourself why. Because probate tax in Ontario is pretty minimal. It's
Yeah.
1.5%. And yeah, no one wants to pay tax, but
Right.
sometimes we have to. But some of the tactics that we adopt because we are laser focused on avoiding that 1.5% tax are much worse than the cure is actually worse than the disease sometimes. And that's where, if you ask yourself why 5 times on something like that, you ultimately, and you want to have somebody there who will challenge you on that too.
Hmm.
So you can do it to yourself, but we're not very good at interrogating ourselves. It's good to have somebody else say, tell me about that. Tell me about that. And I guarantee you, if you go through anything like that about 5 times, sometimes you have to get to a 6th question, you're going to end up at the pith and substance of what's driving your desire to avoid probate tax. And 99 times out of 100, Kevin, it's because you love someone tremendously and you want them to get the full benefit of what you have to give, whatever that is, or you're giving it to charity or something. You just don't want there to be waste. But what happens, and it's amazing, is it always comes back to the beneficiaries. And yet they're the ones that are ignored because we focus on tactics way too much.
Wow.
We start at the wrong point. That's basically when you highlighted that the way we plan destroys wealth, it's because we start at the wrong point. We start too late.
We've got a question.
I mean in the process.
Right. Okay. We have a question here. What do you think of putting land in partnership with heirs, both non-farming and farming heirs alike?
Well, I don't practice law, so I can't give technical answers. And I wouldn't want to. It's a pretty technical question. But at a conceptual level, if we want to deal with it at a conceptual level, you have to remember, what a partnership is. And there may be risk associated with that from creditor protection. So if we look at the structure itself, I mean, that's often done for tax planning. That's my understanding. So I won't comment on that. But structurally, there may be, it can still expose us to creditor issues, and ex-spouses are creditors, right? A child's ex-spouse is a creditor. So what I would often suggest is, to look at that differently. Does the partnership, if your goal is, say, that you don't want an in-law, a married in to the family, to achieve any access or value access to a particular asset, does the partnership achieve that goal? It might achieve a tax planning goal, which might also be achieved another way, but does it achieve that other goal? And that other goal, as I've mentioned, 99 times out of 100, that's what people are most concerned about. It's the money. I know we like to think of it as being the issue, but it often isn't. It's the disruption that is.
For sure. So this might be a somewhat related question that's asking, how do you plan for fair distribution of wealth with non-farming children if basically the assets of the farm are being willed to one child, for example?
So that's your fair versus equal.
Right. Yeah.
So
are there patterns out there of how people have done this successfully and not chop the family into pieces?
Well, I mean, tactics that can help achieve that are free structures, acquiring life insurance. I've seen some really interesting strategies over the years, and you got to start sometimes earlier on this just because of the costing, but where the non-farm children will be entitled to a life insurance distribution, and that some of the farm income, if it's possible, some of the net farm income is used to fund that. It's used to create an estate. So I don't sell life insurance, but life insurance is for sure a very powerful tool. And I know it's not farmers in particular, it's not their most favorite way to deploy surplus cash, but it is a way to create an estate. And if you go through a very purposeful process, most of the time, I think you identify that you don't want to leave that horrible mismatch. And that's what happened on that estate freeze. I mean, the mismatch was terrible. It was a real testament to the person who had the estate, the farm frozen over to her, that she actually wanted to reorganize some of the assets. You can do that, but that's got its own dynamics associated with it. Life insurance, planning in advance and understanding, what has to happen in your planning and what can't be allowed to happen. So if you go through a purposeful, goals-driven process to identify a couple of things that from a tactical and strategic basis that must never be allowed to happen. So if, we're getting into the Christmas season here, if one of your goals is that the children can always sit together and speak to one another cordially, and with full understanding of everything that's happened at their Christmas table, then I think you want to invite some of those strategic solutions like life insurance much, 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 much earlier in the process, because they do go away. I mean, people have strokes and people have car accidents, and then those other, it just gets harder and harder and harder. The more we procrastinate, the more we avoid the planning, the worse the solutions tend to get, the more cumbersome actually they become. So you might end up with a fairly complicated corporate structure that links ownership with different share structures. And there's ways to do all of these things, but it starts to become less clean and more cumbersome. So it moves from simpler to very, very complex.
Yeah. You've mentioned a number of times in this presentation about, this not being an event, but a process, and starting well in advance.
Yeah.
Could you put a number on this? Because there are a lot of complicating factors here. We do our tax return because it has a deadline. We don't do estate planning because, of course, the only deadline is when you die.
Right.
So
right.
how far ahead should our family start? Let's say I pick a day that I want to transition the farm. How far back should we start?
Well, that's a fabulous question. And the reason it's so fabulous is that there are different lines of answers that flow into this. So from a tax planning perspective, I won't give a technical answer here, but I think a lot of accountants, if any are listening or who listen to this later, would say that to make sure you can access the optimal amount of tax optimization that can be done with certain techniques, usually want to start no less than 3 years in advance of the actual transition event. Okay. So now we're starting to get a longer window. I say, totally, that's something you want to do. I tend to look at it as soon as the children are actively engaged in the business, either working, or if you want to be somewhat arbitrary, pass over the age of 18 and begin to take on legal responsibilities as legal adults. That we should start to do some of this family meeting planning where we're starting to share values, understanding what we can share, understanding where some of the communication gaps and misunderstandings are going to be, understanding, maybe that somebody's going to have a personal development plan to get them ready to be a successful inheritor of the farm or acquirer of the farm, and their sibling may need less, and we don't want that to be a source of discontinuity in the planning. So right around the time they're turning 15 to 18 is a really wonderful, you can do it earlier. I've worked with some families that have family meetings where they're starting to bring the really young kids in, and they'll do an activity, and then they'll have the children involved in a decision-making activity, not where any real decisions are made in terms of the farm, but real decisions are made in terms of the family. So one of the paradigms for planning that many of your listeners, many of the people listening in on this will be familiar with, is the 3-circle model that's often used. And there are decisions that are made in those family circles, and we can build strength at decision making by dealing with how are we going to celebrate Christmas this year? What are going to be some of the aspects of that we might like to change? What new traditions, what would we want to create? We can build strength at a very young age. And then, we're building strength, but we're also seeing where there are shortcomings in areas that we want to be able to build on and help ramp them up to the level they need to be at. So I suppose what you're getting from that is that there's no such thing as too early, really.
For sure.
As soon as they can participate, really, in any meaningful way, whether it's in the family circle of decision making, but hopefully a little bit before they're starting to make decisions on ownership or management.
And of course, I wasn't referring to wills because, of course, that needed to be done yesterday, right? So, and if it's not done yesterday, then it needs to be updated immediately. Another question here is looking for a bit of clarification about that segment you talked about, that so-and-so receives a greater share of the estate because.
Yes.
And so the specific question here suggests, I would have thought that the explanation would remove doubts. What is an example, if you can, of a better way to do this particular one?
So that particular example has cropped up over the years in wills. I see it in a will. So it'll say Billy gets $1 million and everybody else gets $250,000, just to keep it really simple. So they're getting a greater share. And that's all it says, for example. What I'm suggesting there is that in the will, that may come as a bit of a shock to the children. They may have thought they understood what was being communicated, but we all understand from our own perspective. And leaving it in the will like that is harsh. You're gone. And no one can turn to you anymore and say, geez, Dad or Mom, what did you actually mean by that? what message are you sending with that? So I'm not saying don't do it. You can do that. I'm just saying, I used to have a lot of clients when I was working in the financial services industry, and met a lot of farm clients, and they would say, I often hear that you can't rule from the grave. Is that true? And the answer is no. You can actually, lawyers are very clever. We can rule from the grave, Kevin. The question is, should we? And that's where you want to go with that. I think you want to say, you want to look to your future self and say, okay, I've passed away. I'm giving a bigger gift to one of my children versus the others for whatever reason. They're your reasons. They're not illegitimate, but there's no communication strategy associated with that. And it's landing in their lap, and now they have to interpret it, and you aren't there to help with any clarification. So where are they going to go with that? They're going to go against each other, et cetera. So I'm suggesting that if we back that process up and we start the communication strategy first, then we can pop that kind of an ordinarily red flag type of phrase into our will.
Nice. Well, Chris, I appreciate all of your insight. We could probably keep going here for quite a while, but they've given us a few extra minutes here because such good questions and dialogue. But I do appreciate the insight that you've given us here today. And so even though we don't have an audience in a room like we're used to, you need to know that there is a big virtual round of applause happening out there right now for you.
Thank you.
So thanks very much, Chris, for
I want to thank everyone. There. Kevin, you did a great job hosting, and everyone at FCC, including Stacy, for organizing this event and thinking of me to be a part of it. I'm honored to be a part of this conversation, this really important conversation that people are having with themselves and with their family.
Well, we're going to continue the conversation a little bit here. Before we wrap up, we've got something special, as I mentioned off the top, that Farm Credit Canada is offering the chance to stick around here for a little bit if you'd like and chat with the Agricultural Transition Advisor team. And so in the main menu, if you can locate the main menu on the screen, you're going to find the words Networking Lounge. And there are several of them in there. So look for the one that is closest to your area. And one of the ATS team will be available to just have brief conversations. These won't be in depth, but at least it'll give you a starting point. And these are small groups, and FCC will follow up with you if you want them to, if you specifically request them to set up an individual meeting at a later date with one of the ATS folks. So as you prepare for that, in a couple of days, you are going to receive an email with a link to this recorded event. Feel free to share it with family or colleagues. That'll probably come in a few days. You'll also receive an email with an event evaluation. Farm Credit Canada really values your feedback because it helps them to plan their future events. There's also going to be a link in there to upcoming virtual events. Our next one, by the way, 2 weeks from today, Tuesday, December the 15th, 2 p.m. Eastern, it's the same each time. Jesse Hirsch is going to chat about how to digitize your farm. And then some of the smart folks from the Ag Expert software program are going to be here to answer some questions about that program. So as always, please register to attend. The details, as always, are at fcc.ca/events. And so on behalf of FCC, thank you for loaning us some of your valuable time. And if you are departing at this moment, make it a great day. Bye to the rest of you. And for those who are sticking around, be sure to check out some of these virtual meeting rooms that we have, and they'll answer your questions. Enjoy your time and keep your microphone and your camera on.